Institutionalizing Crypto, moderated by Henry from Kraken, who is, I guess Kraken's been in the news anyways. Yeah, I hope you guys enjoy. I'll let him take it away. I won't talk too long, but thank you guys for settling down.
All right, good afternoon, everyone. My name is Henry. I'm a VC investor at Kraken Ventures. And today in the panel, we will discuss the topic of institutionalization of crypto. So in terms of agenda, I'll give a quick intro and then let everyone else do also. And we're going to have a 30 minutes to discuss a few questions around institutionalizations and then open up to the Q&A if anyone has any questions in the last 5 minutes. So in terms of introductions, right, I think what we've seen so far over the past 2 years is the increasing rapid growth of crypto. But then just last year, there's a huge shakeup, right? It's basically a huge shock to the industry. And it can be from, a lot of things, but really just two fundamental. One, as an extension of the financial market, right? Like crypto was dragged down because of the impact of interest rate. At the same time, there's some prominent crypto company and also individual really, I would say, act irresponsibly and really dragged out the industry. And I think it's actually, given that blow, right, I think we still very pleasure to be here because we can, during this downtime, can sit together and discuss, look at it, opportunity as a way to, I would say, bring up, see the crisis as a healthy function of the market so that, we can build together again and then bring more institution into the space. And with that, I want to introduce our three panelists. Julia, can you go first?
Hi, does this work? I'm Julia, here from Alpha Lab Capital. We're a crypto-native market-making trading firm, and I run the services and venture arm.
Kevin?
All right. Normally when I hold one of these things is for when I'm freestyling, but my name is Kevin March. I'm one of the co-founders of Floating Point Group. We're a prime brokerage based in New York City, and we help institutions handle their crypto. So I'm sure I'm going to have a lot of very insightful things to say for this one.
Awesome. Hi, everyone. My name is Mihao. I lead strategy investing at Arca. We've been running now for 5 years, properly designed to service and cater towards institutions and sophisticated accredited investors with several different strategies under our hood. Between illiquid and liquid funds, we cover the full gamut and spectrum of digital assets, all the way from all the liquid tokens through NFTs down to the private markets investments.
Awesome. So I'll have 4 topics that I want to discuss with you. But let's start with a big picture, right? What factor that lead the institution that go into the space? Anyone want to go first?
Yeah, happy to kind of kick us off on the overall institutional landscape, as we seem to be sitting very much at the nexus, talking to a lot of our traditional allocators amongst the LPs, being pension funds, endowments, as well as the allocators and distributors, all the way to traditional financial institutions that are examining this space for the ways they can enter and participate. The element that we are seeing shaping this landscape today right now is demand. And there is an incredible pent-up demand, particularly from a variety of different pockets globally, but also here in the United States more specifically, from the ways that institutional investors can access digital assets in a safe and secure manner. And that demand has led us to anything from outcries for a spot ETF, which maybe is coming, who knows these days. Right. Very timely panel today, all the way to ultimately being able to participate as an LP into active investor managers like Arca and ourselves. So demand has been probably the forefront of what has been driving some of that appetite and increased headlines that these days you're seeing daily about institutional interest in the space.
I think one of the things that's enabling that is that you have these products that people are building that are increasingly getting more and more mature, right? It's where you have these startups that come out and, in the first year they build a product that can be used by a couple of people that are close with the platform. They're willing to deal with the fact that it's buggy and that it's difficult to use. They build it a little bit more. They grow, they get some VC funding from one of these three folks, and then from there they can mature the platform. So what you see now is that we're 5 years past the 2017 bubble, right? That's a lot of time to build out mature platforms. So in the wallets category, you now have multiple billion-dollar companies that have built out enterprise wallets. You have custodians, you have prime brokerages, you have blockchain analytics. So now we're at this point where you can start building for larger customers. And suddenly financial institutions can look around and see the sorts of products that they're going to need to use and start to imagine how they're going to be able to use them within their overall platforms. So it's kind of been this game of building for slightly larger customers. And the customers are growing at the same time as the companies that are building them. And now you can actually start to build an ecosystem of mature products.
I think it's twofold. On the one hand, institutions are driven by demand from their customers, right? So just a few months ago, Fidelity announced that it was going to allow crypto into its 401k investments. And that was something that was probably years in the making. And they announced it right around the time of the FTX crash. And they actually faced a good amount of backlash. But they held course and they said, no, we're going to do this because this is something that our customers want. I think on the other hand, you also see that institutions are very curious about the technological potential here. So there you have, just as an example, the likes of JP Morgan and Goldman Sachs. They've launched their own private blockchains that they're using for trading debt offerings within their companies. And I think that's also very interesting.
Got it. So now that we know that institutional investor and capital here, what do you think the impact that they have on the the wider crypto community and industry?
I would take almost two sides to the impact that we have seen in the 5 years of being active in those markets. There are the positive outcomes, and then ones that perhaps weren't necessarily envisioned or desired by the broader crypto community. On the positive side, I would say there's an introduction of a new liquidity pool, pool of capital that has entered this space and ultimately help make some of those ecosystems a lot more attractive from an investment standpoint. For any of those institutions to actually enter and participate in size in a meaningful manner in these ecosystems, they knew require ability for them to hedge their positions, so variety of different derivative instruments that need to be materialized, all the way to ultimately being able to position themselves in a portfolio vis-a-vis their investors for that potential risk-adjusted return. Now, we are also seeing the other element of institutional investors entering this market, and that is a much further and greater regulatory scrutiny that they bring with it. That is to say, vast majority of the allocators in this space that actually hold any form of licensing, whether it's RIA or any other kind of 40th Act license on their book, are obliged to report everything that they do and all the investment activity in a very different manner that perhaps some of the more native investors in Web3 have to date. And so with that comes greater scrutiny. A lot of, I would say, dirty laundry of the space has been kind of aired out as a result. And that is maybe not necessarily the path that was expected when we are all beating the drum of institutions are coming. But it's here, and kind of that proverbial genie is out of the box. And so it's more now about this space to collectively adapt to how we do it and transact as an institutional in a safe and secure manner.
Got it. Julia, Kevin?
I'll jump in. I think probably one of the negative effects is that it calcifies products a little bit. What I'm getting at here is that it's when you already have an incumbent customer base, like as a company, when you particularly have like very large, very important customers that are difficult to work with, it becomes very difficult to iterate and to innovate beyond that point. Because like, I'll tell you today, we shipped a feature to prod without telling any of our customers. And it was like, surprise, like here's this new feature, like I hope you guys enjoy it. And of course they did because it was fucking sick. But what I'm getting at is like, you can't do that when you have 10 banks using your platform, right? So there's gonna be it's not just the banks as well, it's just like overall, like all of the customers are getting larger. So if I am, let's say if I'm a fund and I manage to get like the Texas Teachers Pension Fund as one of my LPs. One, that'd be awesome because they write pretty big checks. But more importantly, like the things that I can then do as a fund have a lot more scrutiny. Now, one might argue that the scrutiny is better, but the other side of it is that, like, with greater stakes, the things that you can actually do and the pace to iterate actually slows down quite a bit. So there's almost like an argument that's like it's good for the industry to stay small for a little bit because it allows us to have a chance to use this technology and figure out what we can do with it before we actually make it to the big leagues.
Yeah. Absolutely, I would agree with that, and I would add that with institutionalization comes new pressures and demand for new products and new features that we didn't see before, right? So custody is a great example. The motto of not your keys, not your coins, works great for individuals, but if you are a SEC registered asset manager and you have more than $150 million in assets under management, you need to use a third-party custodian. You cannot hold your own keys. Right, so now we have to have products for that. We need to have solutions around that. That's just one example.
I see. So maybe zoom in a little bit in terms of institution, like how it works, right? I'm curious to know right now how institution actually invest in crypto. Like we are, what vehicle, what spectrum? Maybe a good, on the
sure. Per my understanding, most institutional investors that want to have some exposure to crypto kind of starts and ends with very simply just holding BTC and maybe ETH, right? If they want to get a little bit more exotic, they might venture into derivatives or venture capital. There isn't a whole, they haven't gone that much deeper than that, I think most of them.
Yeah, there's kind of this dichotomy where when you think about like all of like the really big asset managers, there are some that have decided that they're not going to allocate until they have all the questions answered, right? Like, how am I going to hold my crypto? What is the legal relationship that I should have with an exchange? Like all of those big questions, right? And there's some others that are just like, whatever, we'll figure it out, right? So they're taking like partner capital, they're setting up these like mini funds within like their entire like parent organization. They're training employees to deal with things like using MetaMask retail, right? Not even MetaMask institutional, by the way, right? So these people are willing to take like $10 million, go invest it in whatever the traders want to do, and hopefully it makes money, hopefully they don't lose it, but the lessons that you're learning as you're doing that are very, very important. So these people are like miles ahead of the competition, right? Because like, sure, like they're not running a lot of money. They're running $10 million. It's a blip in the overall like $82 billion they manage as a fund, but they know what they're doing, right? So it's those folks are very laissez-faire. They're risking their own money because they don't know how to work within the overall regulatory structure they're in right now. But it allows them to learn the lessons they need to do. But yeah, otherwise, people are just
There's
buy and hold Bitcoin.
There's a big difference between family offices and teachers' pension funds.
Huge, and we can certainly attest to kind of talking to both worlds. Indeed, some of those due diligence processes that take place, particularly on the institutional allocator side, can really stretch into sometimes years before they write you kind of the first check. And especially as an emergent manager coming into this space, there is a very different standard of care that you have to demonstrate as far as your internal processes than you had even 3, 4, 5 years ago. So that level and then that bar keeps rising. And we are seeing that that also creates quite a wonderful white space for a lot of innovators, builders that are coming to the space and realize that even though we've been at it for 5+ years, it's still not fully fleshed out or built out. There's certainly elements right now that are in a very high demand. We are actively big power users of those and like to invest in those categories in risk management, variety of different compliance modules that will be necessary to kind of unlock that next wave of capital that to a large extent has been in a little bit of a sit, wait, assess mode. And certainly events of the last year have not helped them bring them over that hurdle. Until effectively that infrastructure is set in place and we do have the level of tooling that indeed is orders of magnitude better than what's currently available in TradFi.
Got it. I want to stay with you a little bit because you talk about risk, right? And I'm curious to know from an institution point of view, how institutions really perceive risk in crypto.
Well, there is quite a bit in kind of the risk category. One for sure, a counterparty risk has been a really significant one. And if we just kind of trace back what has happen over the course of last couple of months, especially with the variety of different access to credit, and many of the credit institutions in this space have effectively shut down or have been exposed to a lot of the potential abuse that went not only into the underwriting, but more importantly, reviewing and examining the other parties that you're dealing with. So that is the unfortunate element of, I believe, the centralized finance that has kind of brought in a lot of what I would say traditional toolkit from the TradFi that perhaps was not adapted and not attuned to some of the characteristics of this market. And that is especially at the nexus of both worlds, where we have seen a ton of abuse, a ton of mismanagement, and lack of disclosure and transparency. So I would say probably one of the biggest risks that we undertake when reviewing any and all positions of ours is ultimately, what do we know, what are the known knowns, and more importantly, what are the known unknowns, and try to effectively decipher whether we will take a risk-adjusted position in those names.
So I'll go out in a different direction, which is when you go and you talk to like the really big custodians that are in the space, like Boney Mellon and State Street, their view on risk is actually really interesting, which is they're asking questions like, what is the Nakamoto coefficient for this blockchain, right? Like they're saying like, what is the likelihood that this blockchain that I'm going to support for custody is 51% attacked, right? Because in that case, then their custody is useless, and no one wants to see a headline that says State Street robbed of $50 million, right? That's pretty bad luck for a custodian. So they're looking at things all the way at like the most base level as they're thinking about this, but they're also thinking future looking, right? They're thinking about, I know I'm not going to get a really revolutionary product to market today, right? Like I need to iteratively make little steps to get there, and the reputational risk that I take during that process will drastically affect what this product looks like 5 years from now, right? So there's so much due diligence that they're doing on their counterparties for everything, just because of the reputational risk. Like they don't want to see a headline come out that says, you know, XYZ custodian working with crypto company fails to notice that, you know, the crypto company was backed by North Korea or something like that, right? So the number two thing is really the reputational risk, because they know that when you're a financial institution of that size, the amount of risk of like the headline risk effectively, it outweighs most of the other risks that actually come from doing business in the space.
Yeah, I would add that I think most institutional asset managers, they are well experienced in managing financial risks, right? Like diversification, you know, margin, duration mismatch, et cetera. They are fairly well experienced also in dealing with regulatory compliance risk. You know, they have dedicated officers for that sort of thing. I think the area which is probably the most new and difficult for them to master is the technological and the security risk, right? Asset managers traditionally do not have to worry about hacking or smart contracts. And this is a whole area that they need to upskill on very quickly.
Actually, going a little bit further on that, like the insurance markets also have no idea how that stuff works either. So you can't even get someone else to underwrite that risk, right? Because when you think about the types of insurance that people want, like, you know, I want to go put my money in Curve, right? Or I want to go just trade with Curve, right? You know, I have $1 billion of USDC, I want to trade that into $1 billion of USDT, Curve's the best place to do that. The insurance underwriters, you first have to teach them, like, what is a smart contract? Why would I use a smart contract? Why the hell am I doing this on chain? What is a stable coin, right? Like very basic questions where they have really, really specific nuanced understanding of certain pieces that they've already figured out, right? Like when you go and you talk to like Lloyd's of London, like the really big insurers, like you can ask them, or they'll ask you like nuanced questions about like wallet structure that suggests that they understand the difference between like a multi-sig and MPC wallet, a cold storage solution. Like they really get it, right? But anything out of that, they don't get it. So there's nowhere to lay off this risk either, which I think is really like the other big problem when you're thinking about these risks, because you just have to handle it internally, which this is kind of one of the first times this has happened.
Got it. And in related to risk, I'm curious to know in your opinion, right? What are the challenges that institution is facing, especially in this context today, maybe things related to regulatory risk? Do you have any view on that in terms of the challenge for institution?
Yeah, that's a loaded question, and thank you, Henry. This was one that certainly comes up on our discussion agenda internally at ARCA quite often. Element that perhaps frustrates us to a certain extent, because we, of course, having quite a wide-ranging mandate of participating in a lot of liquid tokens and a lot of ecosystems and a lot of governance campaigns, do tend to appreciate the level of innovation and ingenuity that emerges at the ground level. But an element that we always struggle with is ultimately the favorite trope of this space of testing and prod, testing and production. If you really relay or try to find any sort of parallels to kind of a slightly better well-known world of Web 2 that we kind of grew up, or at least most of us grew up with, there is no such a thing as shipping out a feature before A and B testing and effectively making it sure that once it hits the shelves, once it hits your iPhone app, it is sound and solid and stable. That has not necessarily been the case when it came to kind of innovation, especially in decentralized finance and some of the more exciting protocols that have pushed this space forward. So in order for that to be accessible to institutional investors like ourselves, but also some of the bigger LPs into us, there needs to be an element of greater scrutiny and almost simulation before anything gets shipped out. So I concur Kevin's point on the difficulty of finding the insurance, not even insurance underwriters, but actually the reinsurers, the insurers to go even down the rabbit hole. It's a whole slew of educational campaign that we need to conduct. The element that would make it much more approachable for us is to see a lot more of that simulation before you push any code to mainnet. Effectively stress testing these systems before they go live and start taking a very real fiat into their on-chain environment. So I think the testing and prod, not a huge fan, and I'm hoping that there is going to be a better medium that more broadly will be acceptable to the developer community, because they are the ones ultimately that are the beating heart of a lot of these protocols and ecosystems.
That's right.
In terms of the regulatory environment, I know we're sitting in the United States where the SEC has been making some very aggressive moves lately, but I think it's good to take a bit of a more global perspective and be aware that regulation in different markets can be quite different, right? So if you take Japan as an example, recently, they've rolled back some tax regulation around unrealized profits on token issuances, and that has made it a much more favorable environment. I think some of the other Asian markets as well are looking at, leaving room open for innovation because they want to be seen as hubs of fintech. They want to be the place where crypto companies go to grow, right? But at the same time, I think we still very much need regulation. Regulation can still have positive effects. So coming back around to Japan, after the whole Mt. Gox situation, what was that, 2013, 14? Yeah. 10 years ago, right? They passed a law that says all exchanges have to segregate exchange funds and customer funds very strictly, right? So now FTX Japan customers are, it's looking very likely that they're going to get all their money back compared to FTX customers everywhere else in the world. So.
I think the other thing I'll add there is just like, the regulation piece is particularly challenging because of how dynamic it is too, right? Where you'll have these jurisdictions that'll pop up that want to be the crypto-friendly place. And then they become too crypto-friendly and they track too much, or maybe there's like one bad actor that kind of like sours the mood. And then they clamp down, they create like new regulations that you didn't think that you had to deal with when you like set up a company there. So like thinking about like FPG, like, we're a global company where we have entities set up in the US that face off with our US counterparts. We have international companies set up with facing off customers in certain jurisdictions, right? But it's kind of this game of like cat and mouse from a product perspective of like what features can I offer in which jurisdiction, and then making sure that we keep apprised of that because it changes, right? Where in certain cases, like the requirements around like the segregation of customer assets, like that it's a good thing for that to happen, right? But it does have implications around like how you handle like deposits and withdrawals that are coming in and out from like very small amounts in certain wallets, right? So to be able to offer that, then you have to, like, as a startup company, you have to go get a legal opinion, or it's like, okay, I have to budget in like 15K for every major product feature that I want to roll out, and ultimately it becomes a challenge to build anything when there's so many hoops that you have to jump through in every jurisdiction for everything that you're doing. So, yeah, the regulation piece, I think, probably biggest challenge.
Yeah, I can totally see that from from Kraken Exchange where I work at. One of the big, I would say, like problem we can have is that like it's going to move startup away from U.S. right? Because given the tightened regulatory pressure, innovation, and also a team that will go outside of U.S. and the money will go with that.
Yeah, we've literally talked to multiple teams based out of the U.S. who've built a whole product and were very excited about their product, and then they were told that they were advised by legal counsel that they had to either shut down or move out of the U.S.
Yeah, the reflexivity between capital flows and allocations and the type of and regulatory environment is absolutely at a critical juncture in this space today. We ourselves are having a number of discussions with investors from regions that have a much more forward-looking, progressive mandate, especially on the regulatory government level. And the flow of talent is almost equivalent to a little bit of an outflow. There have been multiple founders that we have been in discussions over the last couple of months that we're buying one-way tickets, literally one-way tickets out of US into multiple of different jurisdictions that perhaps have a lot more welcoming environment. And it's truly a shame for especially the type and level of talent that you're seeing here in the US onshore to not be able to kind of capture and capitalize and give a lot more clarity. As far as even our deal flow and where we are looking to allocate, we're incredibly sensitive to some of those frameworks that are getting currently published and reviewed. Most recently, European MICA, which is being debated and eventually voted on this month and will go into life shortly thereafter. With just that signal that the European government has sent towards the builders and the founders, we're seeing an onslaught of very exciting opportunities right now, trying to effectively tap into and do things right by the regulator, but with some of the innovative primitives that they've been iterating and just simply can't ship out here. So that flow of capital, flow of investor attention, and in response to what is happening and the type of headlines that you're seeing is very real.
Got it. And then for the startup actually still stay right in the US, how Institution really influence the way they build products or really grow the next generation of crypto and services that serve the institution?
I mean, it kind of impacts everything, right? Which is like, it impacts the pace with which a company can grow, right? Like what I was talking about earlier with like needing to get regulatory approval for every single feature that you build. It's not every feature, it's a little bit dramatic, but for like the major features that you're building to have to get like regulatory approval or at least like a legal memo that you can use to defend yourself in a regulatory situation. It just means that you grow slower, which means that you capture fewer customers, and ultimately it means like the structure that's placed upon these US company places them at a significant disadvantage versus their competitors are set perhaps in like an offshore jurisdiction or maybe somewhere that's a little bit more friendlier, such as like, I don't know, Singapore or Zurich.
I mean, I think the institutional space still offers a huge amount of opportunities for startups. If any of you are startup founders looking for an idea, right? I mean, the institutional space it's I think more than twice as large as the retail market in the United States, if I'm not wrong, and I think significantly larger than that outside the United States. Had a good chat with Kevin earlier about how he came across his idea, and it's a great story. But yeah, I think there's a huge amount of space for builders to be working and innovating here. There's a lot of needs, there's a lot of very real problems, and most importantly, institutions have money to pay for it.
Yeah, sorry, I didn't mean to cut you off, but don't get me wrong. Like when I complain, it's not saying like, oh, don't like focus on institutional products in the US. It's more like a therapy session for me. But like anything that's hard, there's value in starting a company around, right? Because like the harder it is, the less likely it is that someone else is going to want to build it themselves, either like a customer building their own solution or a competitor trying to build a competitive product. So like when we look around, like we have like 2 or 3 competitors, right? And if we were in any other space, like, that's relatively rare, particularly like when the space isn't mature. The space, like normally what you have is you have many, many, many companies that consolidate as time goes on, but that's only in like very mature markets. But in the market where you have regulatory structure to deal with, ultimately means that there's going to be less competition, which is nice, as long as you can get through the other hard parts.
Certainly a number of categories that we absolutely love on early stage venture investing that we are actually power users of, especially when you're looking at a variety of different suites for on-chain data analytics. It's hugely important to our liquid fund and variety of different strategies that we are running at Arca. And so we are oftentimes some of the very early test rabbits of those particular systems, from some of the crude and very rudimentary beginnings all the way to what they eventually became today. And so we have several of those success stories where we saw teams with relatively unconventional background, might not have come from the TradFi world, but have come with very much an out-of-box thinking and approaching already well-trodden paths and bringing their unique capabilities of being able to help us decipher all of the on-chain activity that is taking place that inform not only our investment in our venture book, in our NFT fund, but our liquid fund as well. So that is one category where I think there's still a lot more innovation, especially with new asset classes that are now finding their way on-chain, especially in kind of the category of what was a meme in the years prior for all those years that I've been involved, which is the real world assets, now eventually finding their way in a slow and steady trickle, and eventually looking to potentially become a really sizable market opportunity. Very few tools out there to be able to help us analyze and underwrite some of those investments in that space. And so that is one category where we are continuously encouraging the founders that might have been working on something else to potentially consider this huge market that is just only starting. So that's kind of one category that comes immediately to mind. And there's a few more. So if there are any builders out here, absolutely would love to meet after, and we can give you our laundry list or kind of the wish list of what we are ready to fund.
Awesome. Maybe one last question to wrap up before I open up the floor for everyone is maybe very simple, right? Like, what's your view on the space in the next 5 years from now, right? Like, where institutions gonna like really playing and the impact of that.
You guys are VCs. You should kill this question. Come on. I'll kick it off, which is like the things that we're seeing now that seem like they're the likeliest use cases are around the real world assets, right? With the groups that we interact with are looking very heavily at using AMMs for FX swaps, particularly for like international settlement, right? Because like you have all the benefit of an AMM, which is the pricing is transparent, the settlement is instantaneous and it's non-custodial, right? There are TradFi groups that specialize in FX trading that are building their own AMMs right now just for that case, right? Maybe it's not an AMM that ultimately ends up being the vehicle through which this happens, but ultimately like having instant international FX trades, that's a pretty cool use case that I imagine will be one of like the dominant like blockchain use cases that happens over the next 5 years.
That's definitely one. I think, iterating on this idea of real world assets like debt capital markets is another one. I think crypto is, to put it shortly, is going to have its browser moment.
Several, I think, predictions. The few that I would kind of put at the top of my list there, that most likely in the next 5 years in the institutional world, the kind of path or ability to connect some of the dots from where we are today and kind of where we're going 5 years out might not take the kind of more natural and kind of expected path as many of the commentators, including ourselves, envision. But there are already very small signs of pockets of the market where that activity makes sense from a perspective of product market fit. One such area is alternative lending. Has been for a while. It's not a novel concept, and has been for a while now for several decades. It's not a small market either. And so if we can see an element of conversion of that part of a book and come on chain, all of a sudden you can start seeing realistically elements of being able not only commoditize this space, but bring much better pricing to the instruments that are actually on chain, much greater visibility, reporting, number of very mundane and boring, yet huge parts of this traditional markets that many of us came out of and would want to embrace these new technologies. So alternative lending is perhaps one that we are examining very closely, talking to a lot of teams that are helping these fintech loan books find their way slow and steady on chain and give a much greater ability for investors to underwrite those loans. Right now, it's a very paper-heavy business, kind of a favorite dragon to slay by a lot of the blockchain enthusiasts. But it hasn't happened today because, quite frankly, we didn't have a lot of great tooling like we do today with FPG and the peers that are kind of helping out and showing the way of how to build these tools that are resilient and can actually stand up to the test of the institutional scrutiny.
Got it. Thank you so much. Is there any question from the audience?
Thanks. Hi. Really interesting to hear about, especially real-world assets. I've been hearing a lot about, how there's been a heavy shift in innovation in other markets, such as, the UAE, Abu Dhabi, and maybe more permissive regulation environments, even Europe with their sandbox. And the question is, how as innovators can we help, or what can we do to start building these tools? Like, for example, me, from a builder's perspective, I wanted to build a Islamic bond tokenization platform because obviously I can't do it in the States. And now we've pivoted in the States specifically to non-securities, so like watches, wine. So from a regulatory standpoint, what can we do, in the light of what we've seen from other companies that have put a bad light on the space?
Okay, speaking personally, not as FPG, if you are starting a new product in a new company, there's a lot more regulatory risk that you can take in order to find product market fit.
I think if you're trying to build something, well, it depends on really, what it is, right? I think there's still a lot of room to build potentially, I don't know, analytics tools or developer tools or, things that don't take any assets and that are very far from being considered securities. And there's still those areas that can be built. But if sorry, I didn't quite hear what your project was, but if it's something that has, a good dose of regulatory risk, then yeah, I think with the current environment, it's going to be challenging to build that here in the United States.
So I think a big talk right now is minor extractable value, and I was wondering if you guys have any perspective on that or taking it in-house as an institution.
Sorry, can you hold the mic a little bit closer to your face?
Yeah. So like a big conversation topic right now, especially with like post-merge, is block building, using PBS, like using minor extractable value. Do you guys see that as a form of like net P&L that you would potentially take in-house in the future?
Right, so you're talking about MEV, right?
Mm-hmm.
MEV is okay, so I think for quite a few years now, there have been very active MEV searcher teams. As a trading firm, because we do both trading and venture, MEV is definitely something we very much look actively into. There are a number of innovations in the space. So for example, there are some new DEXs that are looking into building MEV like strategies, like flashbots like strategies into built into their DEX. So I think that's quite interesting. Personally, my view on the space is that over the next few years, it will become more and more competitive. And the room for these MEV sort of searcher teams to be very profitable is going to decrease over time.
Yeah, so we are seeing a number of opportunities in this segment, particularly with a range of decentralized funds that are actually looking to plug and play into that backend and run more autonomous strategies. Our exposure to this segment has been primarily on the venture side, so we are very actively talking to those teams and taking them through our diligence. It is in many ways a way for us as well to kind of hedge what the future of asset management in this space looks like. It's incredibly exciting, some of those early experiments that we are seeing. And by all means, we want to have that exposure because we, in the longer term, actually are seeing them as extremely complementary to what you're seeing in kind of active management that we offer to our investors. Just like a lot of the index passive products became a natural component of more actively managed mutual funds as a part of your 401k. So it is getting to that space right now. It's still so nascent that we are more involved on kind of the venture side, finding and backing the teams that are birthing the code to life, and then yeah.
Nothing useful to add other than it sounds great to have MEV profits in my 401k. That sounds great.
Awesome. Maybe one last question.
I was just wondering what your guys' thoughts on like the private credit protocols like Goldfish and Maple. Do you think that they'll be able to pivot to institutional loans, or do you think a whole new like protocol design is necessary?
So for those that didn't hear, his question is, do we think that private credit protocols like Maple, if they're going to be able to migrate over to the institutional crowd, or if they'll need to reshape? To be honest, I think that the way that they work right now is already quite TradFi-y, right? Like our concepts of like collateral management in crypto are very weird in the grand scheme of things, right? Where in most of the DeFi protocols, like when people talk about like the credit crashes of last year, and they were like, look, right, like the DeFi protocols worked. Those ones didn't lose money. Yeah, they didn't lose money because everything was like triple collateralized, right? Which is like incredibly capital inefficient. So to be honest, I think it's a little bit more likely that the protocols like Compound migrate over to being something that's more similar to Maple than vice versa.
I think we're on time, so please stand and applaud to the speaker for the panel today.
Thank you.
Thank you all.
Thank you, guys.